Thanks for checking out the Put Spread Guy. We appreciate you spending time with us. In this episode, we're going to review the origin story of how I got into using the put spread strategy and how I put together a system to make reliable, consistent trades that you can follow along with. If you do decide to trade with us, please do so at your own risk. A YouTube video is not a substitute for a reliable financial planner and advisor. If you need one of those, check out our sponsor, Strongback Financial. No corporate BS, no upsells, just reliable, personalized financial advice and coaching. Check them out today at strongbackfinancial.com. Now let's get into the story. Some quick thoughts to introduce why we like the put spread strategy. The broad stock market, represented here by the S&P 500 over long periods of time, generally yields 10% gains. As we superimpose a 10% gain line on this chart, we can see what an unusual time post-COVID market has been. Hopefully, once we reconcile this bear market, we can continue on the normal growth path that we have seen for years. The big takeaway here is that we should not expect the market to behave like it has for this last year going forward. I would expect the market will be flatter and choppier. I would expect market behavior more like we see in this period for the foreseeable future, which means that tech and even the indexes are probably not going to yield 20 to 40% like we have seen recently. The best way to get good yields may be trading put spreads. As we look, our first play is NVIDIA. At the end of the year, we see this was the hot stock in the market. It was a great tech stock with great products, and everyone was getting on board the semiconductors. At the start of 2022, you can see that it was giving up some of its gold rush, culminating in a large dive in the end of January, as the rotation out of tech stocks kicked in. Just like its run up, it looked like the dive down to 225 was a case of too far and too fast. We see a decent support here at 225, and we have good data to believe that 225 is a good support level that will hold. So on February 11th, we went and put a sell, we wanted to put a sell for a put contract on NVIDIA. So on February 11th, we could sell a March 18th 225 put contract for $14.62. Two contracts would yield almost $29,000. We'd have to back up this put contract with $45,000 of capital to cover in case we were put the stock at the expiration date. This would give us a 6.5% return in 5 weeks, which is pretty good when you look at if you can keep doing that over and over again, that would give you over a 60% yield for the year. Not bad. What we want to do instead, though, is if we look at a put spread contract, we could sell the 225 put for $14.62. And we can buy a corresponding $205 put for $8.24. This gives us a net debit of over $6 per contract. Those two contracts would yield $1,277. The cool thing about the put spread is we only have to back up this combination contract with $4,000, which gives us a 32% return in 5 weeks. And that's really one of the nice things about the put spread is it allows you to make a play with much less capital tied up than if you just sold a straight up put. This allows for better diversification of your put spreads, and it allows, because you have a buy contract here that would go up in value in case you were wrong about a stock, this would allow you some downside protection on that put. So we entered the put spread on 11 February, right around here. On March 8th, the stock violates our floor of 225, and we find ourselves at a decision point. Do we punch out of the trade or do we stick to our position? Well, I actually did option 3, which was have faith in the company and believe it was being treated unfairly in the market. I sold the covering puts at 205 for a $100 profit and backed the 225 puts I sold with $45,000 in cash. 8 days later, the stock bounced up. I was concerned that this bounce would look like one of these bounces, so I closed out the position by buying the covering puts for the 225 contracts for about $1,000 on March 15th. As it turns out, the stock kept climbing into expiration, and I could have rode out the rest of the week and made an extra $1,000. But overall, I made more money than I initially planned on, and I wanted to get out while the getting was good. My volatility concerns were well founded. As you can see, just 3 weeks later, the market curb stomped in NVIDIA all the way down to below 160. So overall, I earned about $1,925 by using the put spread for 25 days. I tied up $4,000 in capital. And then by going straight to a straight up put contract for the last 8 days, tying up $45,000, on average, I tied up just shy of $14,000. This gave me a 13.8% yield for the 5 weeks. Now, I made several mistakes on this trade.
You're an idiot.
And I want to learn from them with you. When the 225 level was breached on this stock and my thesis was thrown into question, I had 2 weeks of time value left on the contract. I should have observed what was happening for about 3 or 4 trading days and then made a call on whether to punch out or stay in. The nice thing about put spreads, like I mentioned before, is that if you have to back out of a sour trade, the lower value puts that you bought to cover capital requirements also give you some downside protection for a poor trade. This won't cover you 100%, but it will cap the downside just in case the trade goes south. I should have done this instead of doubling down with just the sold puts. The second mistake I made was being emotionally invested in the stock. I felt that NVIDIA was being unfairly treated by the market, and I let that be a factor in my trade decision. When you stick by a friend when they're being unfairly treated, you're a hero. When you stick by a stock when it is being unfairly treated, you're just dead money at the poker table. Not good. The third mistake I made was being super happy to find a trade that would yield 30% in 5 weeks. I should have stopped and asked myself if the guy buying my put knew something I didn't. Going forward, we will structure trades with more downside surprise room and a more modest payout. If I went with a 210 or 200 spread instead of the 225 to 205 spread, I would have had more cover for the surprise downside and still made the same money I made on the entire trade without the heartburn and all the capital tie-up. The last mistake I made, and that's a biggie, was I didn't factor where the market was when we executed this trade. Put spreads are a great strategy in sideways, choppy markets and normal bull markets. Bear markets will cause pain, and we were starting the bear market just about this time. To avoid that, I came up with some indicators to protect us. So the first thing we want to do is we're going to watch the IBD market trend indicator, which will tell us that the market is in correction, market's in an upswing, or the upturn is under pressure. This will allow us to enter trades without fighting the directionality of the market. We also will watch the VIX to understand how implied volatility is affecting option pricing. Ideally, you want the implied volatility to be growing but not super high. This will allow us time to get a good yield on the put spread without having a lot of risk on the underside. We will monitor several financial newsletters that gauge the sentiment in the marketplace. I monitor many newsletters. Some are perma bulls, some are very contrarian, and some are perma bears. And when these guys all start to sing off the same song sheet, that's when you know you got a market trend moving in one way or the other. And lastly, of course, we're going to watch non-financial indicators, world news, and other things that will help us understand exogenous events that may raise or lower our risk profile. So when you look at these factors for the week ending 17 June, the IBD has us in market and correction. We did have a couple days where it looked like the market was trying to break out, but that quickly reversed and put us back into a market correction. So that is a very large red flag for us right now. The VIX closed Friday at 31.13, which is very high, but it looks like it's trying to come down. It closed out of its Bollinger Band last week and then back inside the Bollinger Band, which usually is an indication that the VIX is trying to lower and subsequently the fear in the marketplace is lessening. So that's maybe a flashing yellow light saying, hey, it might not be all doom and gloom, but keep an eye on it. All of my newsletters indicate that big money outflows look overdone. So maybe we're seeing the end of panic selling and start to look for bargain hunters come back and enter the market. All of the newsletters seem less suicidal than they have been for the last couple of weeks, and even some of the perma bear bulls are suggesting we start nibbling at some stocks on sale. The world events, however, don't look fantastic. We still have a war in Europe going on. We have the Fed tightening because they seem to be the only people looking to tackle inflation. And the way they tackle inflation is hurting people and triggering a recession. So that's not super good. We have still stock shortages in the United States. The baby food issue was super scary. But for me, the straw that broke the camel's back is now we're having a sriracha shortage, which is quite scary for people who like flavor in their food. We need capitalism to get their shit together and start working on the supply chain. So are we near a bottom? It's too soon to tell. Unless we have a super compelling setup, and we might have one or two this week to take a look at, I wouldn't suggest starting a position. When we look at my modified cost dollar averaging strategy, I would say we want to invest half of our allocations for cost dollar averaging and keep the other half in cash. When we start seeing the market prove a bottom, we want to put that cash back to work closer at the bottom. Thanks for tuning in to the Put Spread Guy. Please like, subscribe, and comment so you can get all of our updates and all of our weekly reports. You can also get our weekly reports at theputspreadguy@substack.com. Have a great day.